Well, greetings everyone, and welcome to today's webinar, Financial Wellness 101. My name is Marissa Smith, and I'm the Director of Student and Recent Alumni Engagement at the University of Minnesota Alumni Association, and I'm so pleased that you all have made the choice to be here with us today. I'm also pleased to be able to bring you today's session, Financial Wellness 101, with Betsy Everts and Amanda Temple of the University of Minnesota. Financial wellness and financial decisions can be complex, and every one of us has a unique story and individual needs. And this was all true before the onset of these wild and strange times known as the time of COVID-19. So this session will share strategies to help launch you into post-college life, including budgeting, savings, credits, and loans. Before we get started with the presentation, I have just a couple of announcements. First, I would like to thank the Alumni Association members and donors who make initiatives like our webinar series possible. If you're interested in learning more about the Alumni Association, you can visit us online at umnalumni.org/membership. We are offering a ton of virtual programming in the next couple of weeks, and I wanted to share a few sessions that I thought you might be interested in. First, this Friday, we'll be hosting something called Career Lightning Talks, Job Search Strategies for Seniors and Recent Grads. In this session, you'll have a chance to hear a series of short talks on topics instrumental to the job searching process, things like resumes, networking, interview skills, and have an opportunity to ask a ton of questions of career counselors from the University of Minnesota. So definitely check that out. This is happening this Friday. And then next week, we've got a couple of other webinars, including one with a similar topic to today, the personal economic impact of COVID-19, and then exploring the future of work, Gen Z in the workplace. By now, we are all Zoom pros, but just wanted to give a couple of notes about participating in today's webinar. You most likely have joined using your computer's audio, but you also have the option to listen over the phone if that's an easier or more clear option for you. So there's instructions displayed on your screen. And then I know the presenters are leaving time for questions during the presentation, so please feel free to submit those using the Q&A button. All right, let's introduce our presenters, Betsy Everts and Amanda Temple. So Betsy is currently the Assistant Director of One Stop Student Services, and as part of her role, she oversees the Financial Wellness Outreach Campaign. She began working at the University of Minnesota as a one-stop counselor and customer service representative. And Betsy has her Bachelor of Science degree in elementary education and Master of Science in educational leadership. Betsy's passions include financial wellness, student development, and guiding parents and students through the financial intricacies of higher education. And Amanda Temple is currently a student finance counselor at the Office of Student Finance at the University of Minnesota. She has worked in financial aid for 10 years, 5 of those at the University of Minnesota, and sits on the Academic Support Resources Financial Wellness Committee. Amanda is committed to financial wellness education for college students and helping them make sense of their finances now and make a plan for the future. She has a bachelor's in elementary education from UW-Eau Claire and a master's in college student personnel from MSU Mankato. Amanda is also an adjunct with the leadership minor at the University of Minnesota. So as you can see, we are in great hands today, and I'm going to turn it over to Betsy now.
All right, great. Thank you so much for that introduction, and hello everyone. We're happy that you were able to join us today. As Marissa mentioned, my name is Betsy Everts and I am an Assistant Director at One Stop Student Services. And I'll let my co-presenter introduce herself as well.
Hi, I'm Amanda Temple. I work in the Office of Student Finance at the University of Minnesota.
All right, so today we will be discussing budgeting, savings, credit, and loans, as Marissa mentioned. And these topics could all probably be about an hour-long webinar themselves. So we wanted to try to hit on some of the basics to get you really thinking and educated on kind of what questions to ask as you go out into the work world. This presentation was designed with our graduating seniors and recent alumni in mind, so that's kind of our target audience. If you are outside of that, we're very happy you're here, but that was the lens that we had when we were putting this information together. And just some logistical things. I will be presenting on the budgeting and savings topics, and then Amanda will be talking about credit and loans. There is that Q&A feature. If you have questions, we will leave about 10 minutes at the end of the presentation to address some of those questions.
When you start talking about finances and learning about finances, it can start making those the scary idea of finances a little less terrifying, a little less taboo, and it gives you some of the vocabulary and some of the language regarding financial wellness. So that's really what we're trying to do today, understanding that with COVID-19 and all of the uncertainty in the world, that may not be at the forefront of your mind. Things like savings for the future, retirement, seem far way off sometimes when we're talking about being in basically an emergency state. So you may not be in a mental space to tackle all of these things today. It's totally fine. You'll have these resources, and we're going to send out the recording as well as a PDF of the presentation. And then also, if you notice at the bottom of this screen, we've developed a COVID-19 resources page. So when you get the follow-up email, it will be listed on there for you to access. We don't have time to talk about all of those today, but it will include things like SNAP benefits, food insecurity, unemployment, and a lot of other things for you.
Great, thank you. And yeah, that resource guide will help kind of navigate, if you're in a financial strain right now, some of the here and now that could potentially help the financial situation that we are finding ourselves in. So let's jump right in. Starting out with budgeting. So once you are out there and earning money, it will be the time to start choosing how you spend it. And when you're just starting out, it takes some time to figure out how to balance how much it actually costs to live on your own. So whether that is the big expenses like housing, rent, groceries, transportation, to the small things of just hanging out with your friends. It might feel tough to track where your money is going each month when you're starting out. But that's where the idea of budgeting comes in. And we know from talking to students that budgeting can get a really bad rep. But actually, when you start doing it and you become more and more familiar with it, it is a tool that will help you navigate your finances in a way that will be more freeing, because once you have an idea of where your money is set to go, you don't have to worry about those day-to-day expenses and if you should be spending your money on X, Y, or Z, because you've already made that determination ahead of time. So we're going to talk about different ways to build out your budget and then different tools to stay on track with keeping that budget. The biggest thing with budgeting is to provide some level of accountability and prioritizing your goals. So the first step when you're thinking about this is determining what your financial goals are, whether that be saving for an emergency fund or paying off student loan debt or other debt. It's just about making sure that you have something in mind. Additionally, even if you just want to make sure you have enough money at the end of the month, that's a really important goal to be looking towards as well. After determining your goals of sitting down and thinking about where you're going and what you want to take on, the next step is to figure out how much money you're earning each month. And so in this slide, it's just a visual of a sample pay stub. So whether you're getting money from your job or a side hustle or other financial support, it's important to determine how much you have at the start. One thing to note is when you are being paid, it's not necessarily that you'll be taking home that gross salary that you're seeing on the job offer. So on this screen, you can see on the left-hand side that this individual's gross pay is roughly about $1,300. But then on the right-hand side, it's showing you all the different things that could potentially be coming out of your paycheck, like taxes and insurance or retirement contributions like the 401k listed there. And that then is the take-home income. So once you have your financial goals to guide you, and then you have determined how much money that you have that you can actually spend, that's when you start coming up with the budget. So when you are building out the details, you're thinking about your major monthly expenses first. So things like rent, utilities, transportation, those are the things that you have to take care of every single month and planning for those. Next, you'd want to identify any sort of irregular categories that are coming up. So that would be things like travel or gift, furniture purchases, things that are not necessarily happening every single month. A good example of this is something like car insurance, that you would still want to make sure you're budgeting for it, even though it may not come up until every 6 months, just so that you have the money there and you are ready for that expense. One thing to note is the difference between fixed versus variable expenses. So a fixed expense is something that remains consistent and you know how much it's going to cost every single month. Whereas a variable expense can change and it remains inconsistent, and it can vary depending upon your expenses or different things that month. When thinking about a budget, it's important to identify these categories and then start deciding how to allocate that money into the categories. And this screen is an example of just a screen grab from Excel. That's one of the budgeting tools that you can use and is a great starting point. We'll talk a little bit more about that in the upcoming slides. So going back to the idea of strategy, when thinking about a budget, many financial experts recommend the 50-30-20 strategy. And in this method, you dedicate 50% to your needs, 30% to your wants, and 20% to your savings. And when you are establishing this, it's important to be really realistic about your budget. So say you spend a lot on Ubers every month, make sure that you're incorporating that into your budget, because there's really no point in creating a budget that just looks good or is ideal if you're not going to stick to it. The best type of budget is one that you will stick to and actually will use. So you'd want to establish and look at those categories that you'd already established and figure out where they fit into these categories. And then once you've taken the time to plug in those categories into a budget, you'd want to think about ways to stay on track. So there are a few different budgeting methods. There are some apps that are out there, many different apps, but some that we have used with students when we do financial wellness meetings are Mint or Clarity Money. Those are a couple different apps that will tie to your accounts and help show you spending categories, give you different goals, and help show you how close you are to those goals or if you need to cut back in a certain area. Those two apps are examples of things that will help you potentially stay on track. Another option, which is a really great one if you're just starting out, is to go to good old Excel. And when you open up Excel, there's an option to search. And if you search budgets, there'll be a variety of different budget spreadsheets available to you depending upon what you're looking to get for your goal. And these are nice, as I showed in that example before, because it's all laid out for you. You're really just plugging in your expenses and different categories, and it will do the math for you. So Excel is a great starting point. Another approach is something called the envelope method. And this is where you go through your budget and then you determine how much you can spend in each category. And you physically get envelopes and put cash into those envelopes to spend. So say, for example, you have $50 to spend on coffee. You would put that money in and use that when you're going out to buy coffee. And I know that that sounds very old-fashioned, and there's some cons to this because we don't necessarily want you carrying around a lot of cash. But the theory behind this is all about psychology, that it is much more difficult to spend your hard-earned physical cash and give that to pay for something versus just swiping your credit card. So again, if you're someone who really needs to try a few different methods, that might be one to consider, or at least aspects of that method, if you're trying to cut back on spending or want to be aware of how much you're spending on a day-to-day basis. And then when it comes to different time frames, you don't always have to have a month-long budget. Try a few different things out, maybe a week or 2 weeks, and if it's not working for you, go ahead and change it up. There are other students who have tried a daily budget where they've determined how much they can spend each day, looking at their overall expenses, and then say they have $30 to spend each day. As long as they don't go over that allotment, they'll be okay at the end of the month. And that's felt good for certain people, knowing that they have somewhat of an allowance throughout the month. So again, the best type of budget is just one that you will actually use. Explore around with a few different ones. Try searching for other apps if those Mint or Clarity aren't working for you, and explore what works best for you. Okay, so shifting gears a little bit, we're going to be talking now about savings. So once you're starting to earn some money, it's time to form that really great habit of savings. And I know that, as Amanda alluded to, in these strange COVID-19 days, it might be hard to think about this, but we just wanted to give you some basic groundwork when the time does come that it might be feasible. Financial experts do recommend having 3 to 6 months worth of expenses saved up in case you need to tap into that. However, that might feel like a lot. So we're not saying that that's the end all be all. It's more about putting aside a little bit into a rainy day fund and establishing that habit so that you have something to fall back on in case you need it. And at the most basic level, savings accounts are just bank accounts that you use to save money in that you can access, but hopefully not touch too frequently, whereas the checking accounts are primarily used for receiving and sending money. When you are looking for a savings account, it's important, as with everything, to understand the terms of that account. So if there's limits on minimum amount that needs to be in that account or different fees, it's important to be asking those questions when you're setting that up. And I would also say, find something that's easy to send money to, where it's not where you have to log into a bunch of different systems to add money to that account, because then you might not even access it. And a strategy that I've always used and has helped me mentally is to pay myself first and pay yourself first. So what that means is that when I get my paycheck, I automatically deduct from that check and move money into a savings account so that I don't have it to spend and it's not an option for me. I just pay myself into the savings account first, and then I don't have to worry because it's automatically setting up savings for me.
With the savings account and the budgeting, COVID-19 is an emergency. This is what we want you to have an emergency fund for. Lots of things in your life are going to constitute an emergency. And so having that 3 to 6 months in case you lose your job or you have a massive bill, your car breaks down, or you have medical bills or anything like that, those are all things that that emergency fund is really great for. Right now when you're budgeting, if you aren't currently working or worried about not working, first of all, if you have bills that can be postponed or they're being paused, or you have guarantee that you're not going to get your heat turned off, things like that, you could put that money into an emergency fund right now if you are earning a paycheck right now. And things need to be triaged in an emergency situation. So pay what you must pay first, and then what you could pay, and then maybe reroute some of that money into an emergency fund for a potential future emergency. And then when the emergency is over, you can take those funds back out and throw it at whatever you were planning to use it for in the first place.
Definitely. And an important distinction with a savings account and an investment account is that a savings account is something that you could access that money when the time comes in a quick manner, where it's kind of a holding ground for money that you may potentially need. And it's most of the time not earning very much interest for you. I know that there's very, very small amount of interest. I think I make about a quarter every 3 months on my savings. But it's sitting there and you could access it when you need it. Whereas an investment account is somewhere that is actually working for you and hopefully earning money, and it may be a little more difficult to access, especially if it's in a retirement fund, that you would have to go through different steps to take it out. But just getting into a little bit into investing, of course, with investing, the earlier the better, because time is on your side with compounding interest. So kudos to you for taking this step to listening to information about this. It seems like finances are on your mind, and so hopefully you'll be having the opportunity to set aside some money and get into that compounding interest earlier on. And another kind of basic groundwork that we tell students is that when you are entering in a career, the very, very important thing to start out with is making sure you are contributing enough to the retirement fund to get the employer match. So what that means is that most of the time employers will contribute something to a retirement account for you if you contribute a certain percentage. So at the very basic, making sure that you're putting in enough to get the employer match. If you aren't doing that, it's just like leaving money on the table, because they're willing to set that aside for you. And so you'd want to contribute enough to get the 100% match from your employer. Another term that you will hear is vesting. So simply put, vested is just a term to determine how much of your funds you can take with you when you leave a company. So if you leave a company's employment before you are vested, you wouldn't own the company's contributions. So talking about that match, they're putting money in for you. If you leave before you're vested, you wouldn't be able to bring that with you. Once you get vested, you could take that money with you if you go to another position. Different employers will have different terms for the vesting period. Some may have no time frame before you're vested, whereas others can have up to 7 to 10 years before you're vested. So it's an important thing to ask about and know about at the start of your career, with different employers understanding their rules. And then a question that came up in the pre-survey was in regards to financial planners and if they are important or worth it. So I can't say whether or not you should or shouldn't use a financial planner. There's pros and cons, but I can tell you that when you're looking, you'd want to look for a fee-only planner. That's because you don't want somebody who makes money off of the products that they sell you. Another really important question when thinking about planners is to ask them if they are a fiduciary. And that means that they are legally obligated to work in your best interest. Another really great pro to financial planners is that oftentimes they're thinking about how to navigate your investments so that you have the least amount of tax liability. And that's something that they can really help guide you and think about how to pay the lower amount of taxes and invest more. So jumping into a few of the different retirement vehicles, because this also came up in a pre-survey question of just trying to understand what some of these different retirement options are. So we broke them down into pre-tax and then after tax. So on the left-hand side there, the pre-tax accounts, if you think back to that pay stub where I was showing you on the left-hand side the gross pay and the right-hand side was taken out of your deductions, pre-tax retirement accounts are contributed to your retirement fund before you're taxed. So that's things like 401k, 401a, etc. And just for your information, when you hear those numbers like 401k, 401a, 457, that really is just getting down to the IRS code that defines those retirement vehicles. Most of the time, a 401k is an retirement vehicle with a private sector employer, whereas a 401a is a government or nonprofit employer. But they're both just pre-tax retirement funds. And then there are a couple of optional additional retirement accounts like the 457 or 403b if you wanted to throw more money into a retirement account or had that option. The rules, of course, with all of these vary. And so it's important to understand and ask questions to your HR department about any fees for taking them out early, or if there are penalties for early withdrawal or changing them around. And then another pre-tax account that's worth mentioning is a health savings account. Oftentimes, these are tied to a high deductible insurance plan. But the benefit of a health savings account is that you're not taxed on it on the front end, and then you also are not taxed on it when you use the money. So it has a double benefit when it comes to taxes. It's a little bit different than a flexible savings account, an FSA, whereas a flexible savings account has to be used the amount of money you set aside each year, whereas the HSA continues to roll on and be invested until you pull it out and use it. And then on the right-hand side there, we wanted to mention the after-tax options. So this is money that's taken out after you taxed. A couple common ones that you've probably heard of are the Roth IRA or the traditional IRA. So with the Roth IRA, you don't receive immediate tax breaks now because you are taxed on it, but you do qualify for tax-free withdrawals when you do take it out. So Roth IRAs can be a smart option if you expect to be taxed at a higher rate when you begin taking withdrawals in retirement. And traditional IRAs, you may receive tax breaks now depending upon your situation, and the contributions will grow tax deferred, but again, you are taxed on that when you take that money out. And then finally, if you have put money into all these other funds, there's an option of simply a taxable brokerage account. And this is a place that doesn't have limits. The other types of retirement accounts listed here have limits that you can put into them each year. With a taxable brokerage account, you could continue to put as much money into that, and it's taxed when you put it in. Generally speaking, financial advisors will say that it's important to invest in your employer's retirement plan first, and then if you do have money, to contribute to a Roth IRA, and finally the taxable brokerage account if you continue to want to put something in. Getting closer to wrapping up the investment piece, we did want to show you the difference of an index fund versus a mutual fund. This is a very common question that we see when we're meeting with students, and I won't dive fully into this because you'll have the slide afterwards. But in general, an index fund is something that is passively managed, whereas a mutual fund is an actively managed fund where they're trying to pick different stocks. Index funds just follow the general stock market index, like the S&P 500, whereas a mutual fund is trying to find stocks that would potentially beat that. In general, index funds have much lower expense ratios, so it may not look like very much, the 0.09% versus 0.82%, but when we're talking investment accounts, that expense ratio difference means quite a bit. So in this example, on the very bottom row there, you can see that over the course of 30 years, that index fund would cost $1,800 worth of fees, whereas the mutual fund would have been $15,000 worth of fees. But the index fund, the second to last row there, is returning a higher investment annual return. And so even though it's much more passive and is lower fees, you're getting more bang for your buck in that index fund. Again, we're not financial advisors and not telling you what to do with your money. It's just important to understand those distinctions between index and mutual when you're thinking about where you want to put your money. And then lastly, we just wanted to show the difference of what it means to start saving early. Again, time is on your side when you're starting to invest early. And this example shows that this individual who is putting aside $100 a month, starting at 25, versus putting aside $100 starting at 35, would earn $89,000 more over the course of that investment. So they're only setting aside $12,000 of their own money, but the time and compound interest will earn them $89,000 more by the time they take it out at 65. So again, you're doing the right thing by thinking about this. When we get out of the COVID-19 emergency and you may have time to start contributing, it's important to put aside a little bit each month, and time will help grow those investments, and you'll be pleasantly surprised by the time you're looking to take it out.
All right, thanks, Betsy. We're going to move into credit, and one of the things to keep in mind when you're talking about credit is thinking about what is credit. So credit is basically the number that is produced by your history of using money that you have to pay back or having bills, and it shows decision makers and lenders how trustworthy you are to use their capital. That's where the term credit check comes from. They're checking on your history of credit. It's kind of like a real world GPA. If you notice on the right-hand side, the FICO score is the score that is used on the credit scale. Anything over a 700 is considered good. And it's made up of these 5 categories. So the length of your credit, how long you've had a variety of credit options in your life, how much you owe versus how much you have available to you. So the ratio of available credit to the amount that you owe. The mix of credit, so if you have some loans, cell phone bill, some credit cards, kind of a variety of things that plays into the result of your credit score. And your payment history is slightly different than your credit history. So are you making your payments on time? Are you making them in full? Have you missed payments? That can really negatively affect your credit score. And then the gray one is about new credit and new credit inquiries. The more often, especially if you have a lot at one time, the more often you have your credit checked, it can ding your credit and it will drop it a few points. It should bounce back after a little bit, but it will make that go down a little bit. Your credit score is slightly different than a credit report. So your credit report is your financial resume, it's your history, it's all of the things that you have out there in the world of credit. So it will list, you can access your credit report, we'll show that on a future slide, but you can access that and it will show you all of the forms of credit that you have had over the course of your lifetime. I think it ends about 7 years. Things after 7 years start to drop off that credit report and are no longer factored into your credit report. There are 3 credit reporting agencies. It's important to know just those vocabulary terms. So Experian, TransUnion, and Equifax are the 3 names in the credit world that you really need to know. Each one of those will can provide you a credit report, and they contribute to your credit score. So benefits of having good credit are on this cute little slide. So things like getting a lower interest rate on a loan or a credit card, getting better car insurance rates. A lot of times a home, either mortgage or rental agreement, will check your credit to see if you're worthy. Credit history shows that you are trustworthy with their apartment or their house. And utilities, cell phone contracts, sometimes you can get those without a security deposit or payment plan if you have good credit history. And occasionally, an employer will check your credit history, particularly if you're applying for things at like a bank or CPA, those kinds of positions. The other thing that it can help you do is qualify for a loan without a cosigner. So as you're finishing up school, you may have had to have a cosigner on some of your student loans if you have those, and you may want to end up maybe refinancing those or getting a new loan to help pay back your old loans. Having a good credit score will help you to secure a loan without that additional cosigner that you may have had to have in the past. Managing or building credit is quite often a question that we get. So one thing to note is that if you have a bank account, you're doing savings and checking like Betsy talked about, your debit card does not build credit. Only credit cards, loans, and other forms of borrowing will build your credit. Buying gift cards and that kind of thing also doesn't build credit unless you bought them on a credit card and then you're paying back that credit card. So ways, if you already have things like a credit card or a loan, ways to build that credit up and show good credit history would be to pay off the balance in full every month. You should absolutely make the minimum payment due, but if you have the ability to make the full payment, you should do that every month so you're not also accruing interest on those accounts. You can set up auto pay on your accounts. I like to set a calendar reminder to remind me to pay my bills because that's a variable expense in my budget. And so I don't want an auto pay to pay $50 one month and $100 another month in case I don't have those funds yet in my account. So I just set up a calendar reminder so I can move some money around, make sure that those are good to go, but that will help me and help you to pay those bills on time. It's important to check your statements regularly because sometimes things show up on there that don't belong there. So either you may have not purchased something, so either the company charged you twice for something or charged you when you didn't mean to or didn't return the funds on your account when they said that they were going to, or it could be that your credit card information has been stolen and you need to replace that card. Ask for fees to be waived or lower your interest. Asking questions when you have them of your creditors is really important. You can lock your credit. So if you lose a credit card and you think you're going to find it again, you can freeze that credit so that you don't have to cancel the card, but also nobody can make purchases on it until you find that. You can lock your available credit so that it will prevent you from going above prevent them from raising your credit limit up and up and up if you feel like you aren't being as responsible with that. If you have a $5,000 credit limit, you might spend $5,000. If you have a $1,000 credit limit, maybe you're only going to want to be limited to that $1,000. Some ways that you can build your credit if perhaps you don't have a credit card or you've gotten rejected for a credit card or you don't have loans out. So student loan or student cards and store cards often have a lower threshold for getting approved for those cards. So that might be a good place to start. When I was starting out right after college, I didn't have a credit card in college and I thought, oh, I should really build credit now. I got a Macy's card back in the day. I still have it. It's still on my account after 20 years. It contributes positively to my credit score because I've had it for so long. And what I did with that was now once a year, I'll go into Macy's and buy something and then immediately go to the counter and pay it off. So I can write them a check or give them cash to make a payment onto my Macy's card. So I kind of manage that as I go, but I don't actually use it for anything meaningful. You can put bills in your name, things like cell phones or rental agreements or utilities can sometimes build your credit. And then one other good way to do that is if you have somebody who you know, particularly like a parent or a partner, sibling who you can piggyback on their credit cards, they would add you as an authorized user on their card, but you wouldn't actually get the information to use the card. That way, if they have a strong payment history, you can kind of get that as as a side product of their positive credit history. Some other things that I do, or I did when I was trying to build credit, because initially I was really afraid of credit cards. I was afraid to spend too much and to get really trapped into this fear of all of these horror stories I heard of college students having a bunch of credit card debt when they graduated. I did the thing with Macy's, so I would just use it occasionally. One thing you can do is just use one card once a month, and that will help you to start build that credit without going too crazy with things. You could buy only one item, one type of item on your card. So things like gas. If you only buy gas on a card, then you kind of are limited to the amount that you end up on there, not spending more than what's in your bank account so that you can pay it at the end of the month. And then we talked about putting reminders on your calendar to make those payments. Annualcreditreport.com. You can view your credit report for free. If there's something wrong on there, you should follow up with your creditors or your lenders just to make sure that they have the right information and that you owe what you think you owe. Sometimes people look at that and they see a loan that they forgot about, or a loan that they never took out, or a credit card that they never took out and they didn't know that it was out there. And you can do your credit report from each of the 3 reporting agencies, Experian, TransUnion, and Equifax. You can do each of those once per year. So you can get your credit report 3 times per year to really keep track of those things. One way to build credit is through loans. And some of you may have student loans out, either federal through the government, those would be direct loans, or private loans through a bank or a credit union. We understand that not everybody listening today has loans, and that's totally cool. Good on you. Sometimes loans will crop up in our lives for like car loans or mortgages or other forms of payment. I was just looking at cell phones and I had a payment option over the course of many months. That might build my credit in a different way. It's kind of like a loan from the phone company. But knowing these terms and these tools is going to be beneficial for you no matter if you have student loans or not. We're going to talk about repayment options, and then particularly with COVID-19, the Department of Education has put forth some special circumstances that I've never seen before in my time working in financial aid, but all student loan payments right now are paused, so you don't need to make payments on your student loans. And in fact, if you made a March payment, you can contact your lender and they will refund that money to you. You will still eventually owe those funds, but you're also not accruing interest on those accounts, particularly if you're not working right now and you're dipping into an emergency fund or you're worried about money. That might be something that you can pull back on, making those student loan payments. Put that money into what you need now. That might be just into an emergency fund. They're not accruing interest. And if you're working toward public service loan forgiveness, talk about that in a second, but if you're working toward that, these months that the student loan payments are on pause will count toward that as well. So it's kind of like 3 months of student loan pausing that time while the country figures out what the heck's going on, right? There's also this link here for additional student loan resources in regard to COVID-19. There are many kinds of payment plans. Going to studentloans.gov will probably be your best resource, or setting up an appointment with financial wellness counseling meetings that Betsy and I do along with a lot of the other one-stop counselors might be a good way to kind of really get in there and dive deep into the options. But generally speaking, there are income contingent plans where you submit your income information and then your payment is based on the amount of money that you're earning. Or there are standard and extended repayment plans. Standard plan is 10 years, monthly payments, and extended is over the course of 25 years. This next screen will show you one loan for $31,000 of debt and how that might break down into the different types of repayment plans. We're not saying that one of these plans is better than another. It's just a way to look at those things in a way that might fit better with your lifestyle. or with your financial situation now. And you can move fluidly between these plans. You just need to contact your lender to do that. Please note that these are for federal loans, not for private loans. Private loans through banks and credit unions have their own world of repayment options. Typically, they only have that standard repayment plan, but you can contact them if you're having trouble making those payments for potential putting a pause on those while you figure out or while your income changes. So on the standard repayment plan, a good way to look at a standard repayment plan is for every $10,000 that you've borrowed, it's about a $100 payment. So for a standard repayment plan on $31,000, every payment for the course of 10 years is $317, which means at the end you've paid $38,000 on that loan. So you've paid $7,000 in interest to use those funds, and so then you're repaying it. If you paid it off earlier than that, then you would have less in interest overall. The extended payment plan, again, that's 25 years. Those payments on a $31,000 loan are $167, which then at the end you will have repaid $50,122. So considerably more because you have 15 more years of interest accruing on those funds. Pay as you earn is an income contingent plan. So every year you submit your adjusted gross income, you submit your tax information, and then that loan payment can vary depending on how much money you earned that year. But in general, it's about 10% of your loan. 10% of your income. We did this on a $40,000 a year income and at a 4.2% interest rate, just so transparency about how I figured this out. So with pay as you earn, you would have repaid $29,361 on a $31,000 loan. And then assuming that you're doing the public service loan forgiveness, those things usually go hand in hand, that pay as you earn and public service loan forgiveness. You will have $11,550 forgiven in that public service loan forgiveness. Some notes about public service loan forgiveness here. So it's a new program. The first graduates who participated in this program are just starting to have their 10th year of repayments. So public service is government employees and nonprofit employees. You can be eligible for having a portion of your loan forgiven after 10 years of on-time in full payments and submitting your paperwork to the Department of Education pretty much every year. You have to be working in a full-time position or a combination to a full-time position at a nonprofit or governmental agency. You've probably heard some news articles about people who aren't getting approved for their public service loan forgiveness. That's why we are including those 8 common mistakes and some other frequently asked questions, because it can be a lot of paperwork. You have to really be on top of things. But on this loan, you may have $11,500 forgiven. So it's worth it to do that if you're working in a nonprofit or government agency for those 10 years. Know the implications of doing that. If you're the type of person who's going to pay ahead of time or want to pay off those loans early, doing a loan forgiveness program really isn't for you, because you have to wait those 10 years. You have to have 120 on-time in full payments. So there's a bit of financial philosophy or personal finance. Finances are very personal. So thinking about those types of things, what's your approach to finances before you commit to a particular payment plan? That's why we're here, right? If you are not certain of what loans that you may have had out or what financial aid you used while you were at the University of Minnesota, we have this new thing. It was launched in 2019. You can go into your portal and click on the My Finances tab and then Financial Aid History. It will show you all of your loans, grants, scholarships that were processed at the University of Minnesota, including all private loans and PLUS loans. It won't tell you who your servicer is or who you owe that money to, but it will give you a good starting point, particularly for all of the lenders through the U. So it's not going to include if you went to another school or if you have private, like personal loans or car loans, that kind of thing. Studentaid.gov will show you federal loans and how to contact the servicer there. So there's a couple different points where you can really gain a lot of knowledge and access to those things. There's some debt repayment philosophies. I touched on this just a moment ago, but strategies for repaying debt, you can, listen, if you're here, you're thinking about this, you're thinking about repaying debt at all, you're in a great spot. If you're doing any of this, you're doing wonderfully. The snowball method is paying the lowest dollar amount first. So let's say you have 5 different student loans on studentloans.gov. One of those is for $1,000 and then the rest are higher. So snowball method would be to pay off that $1,000 loan first and then tackle the next loan that's the next highest and then the next and the next. Usually utilizing the funds that you were allocating to that first loan into the second, third, and fourth, and fifth. Avalanche is more about the interest rate. So choosing whichever ones have the highest interest rate first, tackling those, and then reallocating those funds into the next lower interest rate options. Working toward loan forgiveness where applicable is also another method of debt repayment. You probably don't want to do both of those at the same time. They don't really go hand in hand. And then choosing between investing, paying down debt, and saving. We got a lot of questions about that in the pre-survey. So we believe that you should have an emergency fund and pay your bills first. So pay what you need to pay, make sure that you're getting all of your minimum payments met everywhere, and then having a little bit of money, $1,000, couple $1,000 set aside for emergencies, and then refocusing on paying down debt. There is a balance to be struck here though. So you can look at interest rates, you can look at where's my money best served, am I accruing more interest in my investment account, or am I gaining more interest in my loan that I have to repay, and which one do I want to do there? For me personally, I didn't like having a loan hanging over me, so I made my purpose to pay off a loan first, and then I worked toward investing. That's just the way my brain works. Your brain might work differently. All of it is good. So that's the end of my talking. We're ready for questions. Betsy, did you have anything else to add before we move forward?
I don't, no.
Wonderful.
Well, great. Thank you so much, Betsy and Amanda. This was no easy feat to cover an introduction to all of these topics in less than an hour. And I really appreciate the thoughtfulness and thoroughness that you put into it. And for those of you who joined us today, thank you for tuning in, and know that you will have access to this recording. So if you need to go back and revisit any portions, you'll have the opportunity to do that later this afternoon. We have received a couple of questions, and if you are still listening and you have any other questions that you want to submit, now would be the time to do it. So I'll invite Amanda and Betsy if you want to open the Q&A tab. And are there any questions that you would like to start with?
Sure.
I can answer this parent credit one really quickly.
Go for it.
If you're added as an authorized user on your parent's credit card, will it affect their credit score? So it won't affect their credit score unless you are utilizing that line of credit also. So if they're giving you a card and you are making purchases on that card and then they're not paying it, they're expecting you to pay that and you don't, that would affect their credit. But adding you as an authorized user should not affect their credit at all otherwise.
Yes, and I can jump in and answer the first question, and it is, what should I do with my 403B when I leave my position for graduate school? What are some of my options? So some options would be to leave it where it is. You can just leave it right there, let it continue in that particular fund. Another option is to roll it into any new workplace retirement account if you have that option with your graduate program, if you have some sort of employment during that time as well. or you can roll it to an IRA. And so those are 3 different options when you're thinking about that additional 403B retirement account. And I do want to add that both Amanda and I have shared our contact information, our email addresses on this slide deck. So if you have more personal questions that you don't want to ask here, or if you want to get more in depth, I'm happy, and I know Amanda is too, to answer any follow-up questions via email as well. So putting that out there as an option too.
One thing with Betsy's question is if you aren't sure what to do with those funds, if they're sitting safely, happily in a 403B account, it is totally fine to wait until you are ready to deal with that. It's not doing any bad sitting there. It's still accruing interest. You're still doing good things with those funds. And then when you're ready to tackle that, that's when you can decide, do I want to roll it into an IRA? Do I want to put it in with a new employer? The thing that we would recommend not doing is pulling those funds out as a lump sum payment. You're charged a 30% fee, 10%, sorry, I don't remember. You're charged a fee and then you're taxed as regular income tax on those funds. So there's a pretty dramatic financial penalty for withdrawing retirement funds earlier than retirement age.
Yeah, and sorry, hopefully Amanda and I don't continue to piggyback, but I think we keep reminding each other of things. One item to note with any sort of investment, particularly in the stock market, is that, at least in my brain, this is how it works for me, is that I pump it in, I put my money in, and I really don't look at it. I don't try to watch these big ups and downs, especially right now in light of everything that's happening. The thing that you wouldn't want to do is to get worried and scared and pull your money out of those investments accounts, especially when we're in a small amount of a dip. And so for me, at least, my philosophy is to not watch it go up and down, because that mentally stresses me out. So that's something, if you know yourself and that might stress you out, try to just set it and forget it. And hopefully down the road, when you do need to tackle it, you'll be pleasantly surprised. But watching every day might just stress you out and be more of a mental bog down than what it's worth.
Anna, there's a couple of questions about paying off loans early. Any advice?
Yeah, I'm gonna tackle a couple of those together, if that's okay. So can you leave them up while I try to make sure I get all of them?
Yes, yeah, and I'm sorry, I just clicked done, so now they're on the answered tab, if you can.
Totally cool.
Yep.
So there's a couple questions about multiple things that affect credit. So if you have multiple credit cards, multiple loans, those contribute to your overall mix of credit on your report. And then the longer that you have those, that can contribute to the longevity of your credit score. The things that are taken into account with your credit score. So by paying off a loan early, yeah, that might dip your credit score a little bit, but in my professional opinion, my personal opinion, I think that paying off a loan is better than worrying so much about your credit score getting dinged a little bit for having a closed line of credit. If you have things that are contributing positively to your credit score, but they aren't contributing positively to your life, screw the credit score. Who cares at that point? Like, you want to make sure that your financial situation and your mental situation is doing better by closing those things out if necessary. Paying off your loans early or starting to make payments on your loans early, if it's a federal loan, if most private loans, if they don't have anything about a early payment fine or making more than the minimum payment, then there shouldn't be a fine with those. You can totally do that. They may make you pay the interest first and then start making principal payments, or they may make you pay the minimum, like with student loans, the minimum payment on every loan that you have, and then you can start making larger payments to one or more of them. But generally speaking, there is no prepayment penalty for those things. So you have 6 months after your last date of attendance to start making repayment on most student loans. Not all of them, but most of them. You can start making those payments early. And let's make sure I covered those other ones. Starting to make those payments early might help your credit score overall, because you're starting to make showing that you can make regular payments. So If you can do that and that's something you want to do, go for it. All of the little things that affect your credit score affect it just a little bit. So, you know, every positive thing that you do will help out over time, but if you don't do one of those things, it's not going to tank it or anything like that.
And I'll add just a couple of things. Sorry, Marissa.
No, great.
If you have a credit card, a lot of credit card companies will show you the option or have the availability to show you where your credit score is at.
Yes.
And so that's one way to track it and follow it, and kind of, at least on my credit card, it will show me if I have any ding, why that happened, or if I have an increase, why that happened. So it's a good way to educate yourself. And then I just wanted to piggyback on one of the questions about the 6-month grace period after graduating and going on to graduate school. The way that lenders and loan servicers know that you're continuing, there is a system called the National Clearinghouse, where they report information about where you're attending school. However, sometimes the National Clearinghouse may not get to your servicer in time, and then you have to request what's called an enrollment verification from your graduate school, just to show that you're continuing your education, and you could send that to your servicer so that they know you're in that 6-month grace period.
All right. Well, we are at 1 o'clock, and I want to, again, thank you all for joining us today, and to our presenters for sharing their time and expertise. And I hope to see you all at another Alumni Association webinar soon. Have a nice afternoon, everyone.
Thank you.
Bye. Thank you.